opening accounts receivable or the closing of the last one.
Right.
Right? All of that is cash going into the company.
And it's not recorded anywhere else by receivables. It's not recorded in the sales.
No. Now this is, hang on a minute, be careful you don't get confused. Sales is in the income statement.
Right.
Cash is eventually in the income statement, but for the cash flow purposes, you refer to the value of the sales, and you're in effect adjusting for the cash you are going to get from those over the period.
Okay.
Keep thinking it through. If you look at that little formula, you will eventually figure out what's happening. You start with an opening accounts receivable, and then a whole heap of cash comes in, and the whole heap of cash that comes in eventually comes out and eventually goes into the cash party balance sheet, all the rest, but at the end of the period you still have a whole heap of accounts receivable. So you have to adjust for those two
Right.
to get the true cash that has come in from day 1 to day 365. I don't think I'm going to go around the block too much more on that. The textbook's not too bad on it if you read the text. Now exactly the same thing applies to the item cash paid to suppliers and employees.
Which would include wages.
Yes,
Thank you.
but you have to adjust for the accounts payable. This time it's the money you owe people. So you start out with the total of expenses at the start of the period. You add the accounts payable at the start of the period, and you subtract the accounts payable at the end of the period, and that gives you the cash paid to suppliers and employees, and it is a minus sign in the cash flow statement. See page 171. There's a long list of questions you got here, Al.
No.
Don't panic. No, don't hesitate to ask questions.
I think you've answered that.
We're getting there? Okay, that's fine. So the,
Because it's only the physical transaction that's taking
Yes.
place. It's not
yes.
whether you actually have an obligation or an owing of something.
No,
It's
that's
just what
something
you-
else.
Yeah, it's just what's.
Just the transaction. Yep. Now, the next heading is the cash flows from investing activities. Now, it probably will help you to write a few more words there that you don't need to put in the statement. Investing activities will be money you have paid for non-current assets. On the one hand, not on the one hand, and that's what you'll be doing. Yep. So investing activities really means non-current assets, which could include a loan you've made to somebody else, but in this particular example, that's not there. Then you've got the whole old list of cash coming from financing activities. Now this is a longer list in the cash flow statement. So first of all, the owners contributed some money in cash, that comes in. You've set yourself up some income in a hire purchase situation, and you get some cash in from hire purchase repayments, and distributions or drawings come out. That's the financing one. a subheading net cash financing activities. Then they show at the bottom net increase. They usually write net increase dash decrease in cash and cash equivalents. Now the bank will look quickly at that, always, and so will the owners for that matter, and say, okay, net increase in cash, that's all looking pretty good. You got your cash sorted by the look of it. You haven't spent too much money on new cars and all the rest, and tied up too much money in cars. If there was a decline in the cash, the bank would be saying, hey, wait a minute, what's going on here? And you'll say, oh, this is just a one-off, we'll come right next year. And the bank manager will say, yeah, well, I hope you do. What are you going to do that? And if you get to the end of the year and you do it twice, then the bank's going to be saying, hey, wait a minute, you're on the way to running out of cash if you're not careful. One of the traps for young players, just as an aside, when people go in and start up small businesses, it's quite interesting to watch what they do. Given that I was running a company that had a couple of hundred bike dealers as customers, you quite often get people that buy a bike shop off somebody because they're the sort of businesses people can buy by adding to the mortgage on their house or taking a big redundancy or so on. So off they go and they set the business going. And they buy some bikes from poor innocent suppliers like us, and they put the bikes in the shop, away they go. So they've got stock sitting there, and then they seem to feel they need a really good ute or a car or SUV or something like that, and they go and buy, I don't know, $20,000 worth or even a brand new one of these things and put it on some form of hire purchase. And then all of a sudden February comes around after Christmas and we're sending them invoices and reminder notes and whatnot saying, hey, what about those bikes you bought back in November? And the simple fact is, they've tied all the money up in their darn new car and excess stock and everything, and they're in trouble. And added to that, I suppose you still have to, provisional tax come around on the 7th of March. And so, once again, it just emphasises the importance of the cash.
Question.
Yep.
You know how you give out dividends to shareholders?
Yes.
Is that an operating activity or is it a financing activity?
Well, look down the categories and look down the items and you tell me. Page 171.
It would go under the drawings to the owner,
Distributions to owner, it certainly would. Yep.
but it would be just, because your shareholders are the owners.
Exactly.
Yes, sorry.
Exactly. It could be one owner or it could be 100 shareholders.
Thank you, yeah.
I think our company had 150 shareholders, so the accounting was a bit more 155 euros, goodness me, including the guy down the road.
So would that be a negative? Because you're giving them money, aren't
That's
you?
right, it's going out, it's a minus.
Yeah.
Again, have a look on page 171, you'll see the brackets, which is the same as minus.
Just
Yep.
with the investing there, the vehicle and the plant are in different columns. Is there a particular reason for that, or is there,
In this case,
because they're both negatives, aren't they?
yes. I don't know why they're in double columns, actually. And
Whenever there was
I simply don't know.
following under that one didn't.
yes, well, it's got a few other odd things about it. It's got a double line under it, things like that. I actually don't know the answer to that.
23, you think it'd be across in the other column, wouldn't you?
Yeah. Well, what I would have done normally, and this would be perfectly acceptable if you do, you put purchase of plant, 23,000 negative, purchase of Nissan van, 15,000 negative, one beneath the other, and then hop across to the total. That's what I would have done. I'm almost wondering if it's some sort of misprint.
It's perfectly illicit,
Yeah.
like, isn't it?
It's quite good to have the second column, but not like that.
Just on that depreciation, so for
Yep.
our example here and what we have in there,
Yes.
depreciation won't be part of
No.
the income statement.
It can't be. in my humble view, depreciation can't be in a cash flow statement.
And that's,
Yeah.
I guess,
Yeah.
so the joys of the internet, that
Yeah,
some seem to
yeah,
have it as part of their operating expenses.
yes, yeah.
And others don't.
But you
Okay.
see, it's not cash.
No.
If you think about it, it's, yeah. And the bank takes note of whether you have accounted for depreciation, but the only reason the bank does that is in case you think that's usable cash. And, well, technically, of course, it is. You can, whatever, but it isn't cash. It's not sitting in a separate bank account or anything like that.
Well,
It's an allowance.
I know years ago
Yeah.
when I was selling motor vehicles.
Yeah.
So most of your motor vehicles in the yard.
Yes.
The dealer owns half and the finance company owns
Yes.
the other half.
Yes.
So when he sells the car,
Yes.
he's supposed to pay the half to the finance company.
Yes.
But lots of them don't. They keep the money
Yep.
and hopefully they can use it for other things
Yes.
until the finance company go, where's our car? Because they come and look and it's not there.
Yeah. It's the same sort of syndrome, like bike dealers who
Yeah.
put bikes on lay-by and then sell them,
Yeah.
having taken the cash for them, and then come screaming to us. They absolutely have to have a new red 10-speed by Friday night, sort of thing. Yeah. That's right.
You'd make that phone call first before you sold the item.
No way they don't. They just sell it. The customers come into the shop and the customer says, I want a red one. And the dealer says, God, I've got a red one upstairs on lay-by. Yeah, here's the red one. Then they will start having done it. Okay.
Question.
Yeah?
You know how you said that your loans and everything and that can be are taken into your cash flow? It would go in as cash received, wouldn't it? But then you would also have to do the negative of in the kind of hire purchase.
Yeah, so if you got cash in from a loan, it would be recorded in investing activities, and equally you may have made a loan to somebody else.
But the fact you own the bank money doesn't come into it, does it?
Well, it's all there.
It's not like a liability. You don't put your liability there, which is what your bank loan is, isn't it?
But just remember, I realise this is a little bit confusing, but just remember the operating category where it says payments to suppliers. I've lost the line. Where is it?
Yeah. Cash paid to suppliers and employed.
It's usually just regarding the bank as a supplier. It is equally acceptable to stick it in investing. You can go either way, so long as you're consistent.
Right.
Yeah. Marking these, I'll accept it either way. I think you're all clean there if you get your heads well and truly around the Golden Chips Takeaways page 71. That's the correct format, and it will give you a guide to what goes where. Right, the next question of your next assessment. Do you have a copy of the next assessment in front of you, which should have somewhere in it elements, statement of changes and equities, etc., etc., etc.?
Yep. Number 2.
It's the number 2, it was at the end of the green packs or the purple packs. It was the end of the green packs or the pink packs.
Yep.
You got it?
Yeah.
Excellent. I haven't embarrassed myself for giving you the answer sheet, I suppose.
Not that we would tell you.
I had a very late night in Wellington one time. I was delivering a diploma in business, and I was a bit was employment relations and the first assessment was paid. It was a block course, and I must admit I was a bit pushed beforehand getting up there and all the rest. And I handed out assessment 1 for them to do to the end of the block course, and they were bloody. I gave them the answer sheets, so they had to spend that night writing another one. What a pain. Right, your assignment. Firstly, for this assessment, you can ignore any references to your own handwriting, and I don't think there is any reference to that. No. No, you can adjust that element. If we miss next week's class, you can add a week to May the 14th too. There'll still be plenty of time for you to complete the course, probably early. Question 1. Now, this takes you back to, I think it was handout number 5 when we were talking about transaction analysis. And there are 2 requirements. The first is to describe each of the transactions for February. Now, it isn't asking you to do any number crunching, it's describing them. So, to give you a bit of a guide, we'd probably be looking for you to say on February the 1st, the opening balances were, and just list them or something like that. That's the longest one. Then you come to February the 3rd. See the minus and the plus? So the bank was minus because they paid cash for what? Supplies. So that the supplies rose, the bank went down. And so on and so on. Then it is asking you in number B to show the information in the form of the accounting equation, which is quite a complex one, this one. In order to do this, all the assets should equal the liabilities plus the capital minus distributions or drawings plus revenue, which is the same as income, minus expenses. So to get the 3 marks there, you need to put a value in for assets. So you need to add up what you see as the assets, and it won't take you long to realise they're all sitting in boxes there, and so on. That's why you only get 3 marks for it, because they're all sitting in boxes. At a quick look, there's not too many complications in that one. The second one is question 2, which is the somewhat larger. There's a great heap of balances from the accounting records. There is at the bottom some additional information. Don't worry about GST when you're doing the additional information. Now, the additional information is basically coming out of these balance day adjustments. And you are given the information.
Question.
Yep.
The last one, Chris has decided to transfer her personal computer with 800 to the business.
Yes.
To To me, she hasn't done it yet, so it's not included in that year's statement.
Now,
Is that correct?
you assume she's going to. It's a
So therefore, it will be in next
it's
year's.
a balance day adjustment. She's doing it at the end of the period.
So you want to put in.
You want to put in. So all of these transactions, you're ending up needing to do several things here. The first is, for a whole 17 marks, you prepare an income statement. And they've said the expenses are to be classified, and those are the required categories. Now remember, not everything in that list of transactions is in the income statement. So you only pick out the things that you believe should go on the income statement. You then do a little statement of changes in equity from that information. And you then do a little extract from the balance sheet showing only the current assets and current liabilities. We are not looking for a complete balance sheet. So probably the slightly tricky ones to remember are the additional information. You've got to do something with the $100 for Maxmart. You've got to split salaries. Take some salaries out. There's a prepaid insurance. And there's a depreciation expenses still to be put in. Question 3 is a cash flow statement, just like we've been talking about. Page 171 in your book will help you categorise it. And question B and C, a little comments needed from you. Question 4. You are given some bits that would typically come from a schedule of assets with the depreciation records. You need to read the instructions very carefully because you've got to add a few bits and pieces. When you come down and you read, the machine was estimated to be of economic value to the company for 5 years, at which time they estimated they would be able to trade it in or sell it for approximately 20,000. When you look in your textbooks and look at this sort of thing, that term will be a residual. The 20,000 will be a residual. In other words, what's left after it's been depreciated. Now, in a way, this isn't particularly difficult because it doesn't require too many horrendous calculations. The first thing it's requiring you to do, number A, is to describe the concept of depreciation. The second thing is asking you to comment on assets costing less than $500, and the question is saying that this can be expensed. In other words, less than $500, you just put the thing in expenses, you don't do anything about depreciation. The question is actually asking you, how does that relate to the concept of materiality? Do you remember that? Is it material to the overall results of the company? Is it significant? And the other concept of relevance. So you're only talking about 2 marks. You just need a couple of wee comments that indicate you know what materiality means. You can look it up in the index if you have a doubt. Now number C and number D, don't get too trapped up on this. Calculate depreciation expense for the new machine for the first 2 years of its estimated life using the straight line method. The straight line method is when you take the period over which you're going to depreciate the thing and you divide it by the number of years in that period. So if the thing costs $5,000 and you're going to depreciate it over 5 years, then you are depreciating it at 5 times $1,000. Page 187 tells you all about that. Number D, this diminishing thing is quite a bit harder. There is quite a complicated formula for it, but you have been given the devaluation method and the fact that it has calculated the rate to be 25%. Now this one is where you take it off the depreciated value each time. And so the first one, the straight line, has the same amount for each of the 5 years, regardless of how much you've depreciated it. The diminishing value one, you start off with the rate for the cost, and then you subtract the rate from the cost, and then you calculate the depreciation on the basis of the subtracted amount. Just get your head around it quietly. It's in the textbook, and the difference is entirely to do with the regular amount per year and the diminishing amount per year. Don't panic, it's only worth 2 marks. But
Is that just the blank looks like a face like, huh?
and remember, in real life, you'll go to the net revenue table for the XYZ bearing that you want to buy and depreciate or something. Question E. Discuss how the calculation of depreciation might compromise the reliability of financial statements and how accountants can minimise this. Have a little bit of a read of the comments that surround this in your textbook. The clue into all of this is that depreciation is very arbitrary. You know, you can't, the rate at which you depreciate things and establish their residual values is not a precise science, and so it's vulnerable to people guessing. So I nearly answered it for you there. The other thing is number F is to explain the effects, if any, on the elements in financial statements, of choosing diminishing value method of calculating depreciation compared with the straight line method. Because I'm endlessly generous, I'll ask you a question or two which should just about get that answered for you. What are you doing